Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 7th of May. I'm Daniel Lam, your host for the podcast. After the frenzy stock market activities in the month of April, equity market volume has quietened down significantly over the last 10 sessions. This benefit of the doubt that the market is giving to the US to make trade deals with its key trading partners does not give a great sense of comfort to the broader investors in general. So today, we will take a look at things from the flow perspective. Well, it's been 5 weeks since the Liberation Day shock, and the S&P 500 is essentially flat. The US equity positioning, after experiencing heavy selling last month, has shown only a marginal uptick. Retail participation has declined from April's high, although it remains steady. At the same time, a small increase in institutional option flows and CTA allocations last week point to some bargain hunting by fast-moving fundamental speculators and marginal short-covering flows from trend-following systematics. We're expecting some choppy trading in the month of May. Currently, the biggest positioning gaps versus history lie amongst discretionary investors, particularly long-only institutions. Now, historically, rapid positioning capitulations, as the one experienced over the past 2 months, tend to see long-only positions recover over the span of 2 to 3 months, but this would overlap with the usually weak second half summer flow seasonality, thus making this doubtful if it can form a strong bid. What about retail? Well, retail participation is likely to remain steady overall over the next 1 to 2 months and inversely correlated to price action as long as labor conditions remain resilient. The swing factor can come with long-short hedge funds and systematic investors, which are faster moving and do historically see equity exposure increase during the months of May and June. Long-short hedge funds are showing tentative signs of renewed appetite as indicated by recent option flows. Systematic investors, they are likely to be constrained by the high realized volatility over the next 3 to 4 weeks. But with improving short-term momentum and dealers' gamma having just crossed into positive territory, this is setting up for a gradually increasing equity bid. So therefore, the above dynamics show that, barring any significant negative growth or policy shock in the coming months, it still supports a mild move up in US equities in the near term. Implicitly, this would entail some de-escalation in the trade tensions, and investors may use this favorable dynamics to trim any excessive positions in US equities and rotate into those in Europe and Asia, where we're expecting good fiscal policy support from the governments there. That is all from me for today. As always, if you enjoy these podcasts, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.